A lot of talk today about what the Fed is doing, low interest rates, and what it means for asset prices at the end of the day. What are the concerns that are baking around for you and your clients?
Sure. Well, listen, thank you for having me, particularly this great setting, great people, and nice to be back in person. In any case, low interest rates are doing exactly what low interest rates are expected to, maybe supposed to do, which is drive asset prices higher. We've seen it in this just upward grind in just about every asset class, right? Equities are up and real estate is up. And, if you kind of look across the board, even if we get into things like, Charizard Pokemon cards, they're up. So, low interest rates have essentially a mathematical effect, and it's of some concern.
Well, are you worried that something has got to give, and a lot of investors may be caught off guard here?
I do, because there's a complacency. Of course, we all have this risk, which is, the new normal, so to speak, and this seems to go on and on and on. But the day presumably will come when we will see asset prices go the other direction, and people are awfully conditioned to the expectation that it's just going to go on and continue well. So I think it's going to be, it's not a reckoning, but there'll be a day where we see the other side of this.
Yeah, I want to pick up there, Mark. I mean, certainly, maybe that reckoning happens. Maybe it's something a little bit softer. I'm curious as to how you position Blue Owl going forward. I mean, obviously, your company and sort of the combination that formed Blue Owl has been a big beneficiary of some of the trends that we've seen in this sort of low rates for longer, if not forever, environment. And I'm wondering if you anticipate at all having to adjust at all your investment outlook and your business model should the Fed actually start to move.
Look, we're very fortunate in the way we're positioned for rising rates. First and foremost, Blue Owl itself, 100% of our revenues are fee related. So we get paid fixed fees, or essentially unrelated to this question of rates, fees that drive both our current earnings and also really give us visibility on future growth, given that we have this permanent capital base as well, as you know. So from a Blue Owl point of view, we actually are quite indifferent. And I don't mean ambivalent, so to speak. We care, but as a matter of business, we're going to continue, knock on wood, to continue to do great and thrive in any environment. Our specific asset classes, to be clear, in particular lending, we're in the floating rate loan business. So actually, rising rates are a direct beneficiary to the people that invest in our funds, because our loans will reset promptly. So this is one of the big differences between our product and traditional fixed income products.
So definitely some differentiation there with regards to the product, and obviously with you and the rest of the management there's a pedigree there that I think would be attractive to most investors, most clients looking for opportunities here. But this is still a very competitive space, Mark. And I'm curious if you think that the competitive pressures, at least the intensity that we've seen over the last year and a half, that might abate.
Yeah, it's a wonderful question, and look, we've been lucky to be in the alternatives business for a long time. I've done it for over 25 years. And look, there's always going to be competition, but I have to be candid. What we're seeing in terms of the secular shift toward private credit and the opportunity, and it's a new opportunity to sell stakes in these ever larger, more durable GPs, which are really the two legs of our stool. They're both really high growth markets where we're picking up market share. So, think about it this way. When we started the Owl Rock predecessor to Blue Owl, I don't think there had ever been a $1 billion private financing. We actually just today, I think it was, completed, committing, or funding our 10th $1 billion financing this year. So this shift that's going on in terms of the amount of market available to the private credit side is far exceeding the supply of capital. So sure, it's competitive, but I have to say we feel very good about the opportunity for credit today.
Mark, a lot of people in the market are talking about Evergrande. Is there a risk of contagion, do you think, or does the Evergrande story say something else about how investors around the world are maybe mispricing risk?
So, another wonderful question. I would say in terms of contagion, look, we have a very domestically focused business. Our loan book is literally 100% within essentially the North America and really U.S. for that matter. Now, obviously, we have stakes in a lot of wonderful global enterprises that have exposures, but again, diversified exposures. So when we think about day to day, which is really focused on how do we deliver for Blue Owl shareholders and for our investors and our funds, it's not really a contagion of significant risk to us. That said, sure, it's a reflection of this sense that nothing can go wrong. And again, back to where we started this conversation, things do still go wrong.
So one more quick one for you. You're in the business of alternative assets. What is the number one asset that investors are just clamoring for in this environment?
Private equity, hands down, particularly with a tech-centric focus. It is extraordinary, both the capital raising and the capital deployment. They're breathtaking by any standard, having done private equity for decades. This is quite a moment.